Hello, Money Multipliers! Welcome back to another episode of the Money Multiplier podcast. Daisy is here joining us today for my friends on YouTube. All right, hello everybody. This is where we ask ourselves, do our dollars make sense? My name's Hannah Kessler, and I'm your host for the show. Every single week on Tuesdays, we upload the podcast here, the Money Multiplier podcast. So thanks for coming back and joining us. And for all my new folks, hello. Hit the subscribe button, click the bell icon so that you know when I upload. And hey, leave me some comments, okay? You can also even send me an email with your questions that you have, or if you want to be a guest on my show, podcast at themoneymultiplier.com. I love just chit chat with you as well. So in today's episode, we're doing a solo one today. I know in my past previous, I've had a few guests on the line, so I'm happy that all of my guests are able to join me. They have a lot of good insight and characteristics that they can bring to the channel. And then also, because at the end of the day, I'm doing this for y'all, right? I want you guys to have the full capacity and knowledge that you possibly can as you move through your financial journey. So today, we're really going to be talking a lot about paying back policy loans. And then also, I got a really good question that I kind of just want to talk about too on today's episode. But the main overview theme is when and how do I pay back my policy loans? Because actually, I was talking with a woman and she was asking me the question of, hey, we talk a lot about how to strategize with the policy when we're taking out the money, when to go use it, and how we're using the dollars from the policy. But when do we ever pay this back? So I'm going to get into that in today's episode. Real quick, an announcement though, if you haven't heard already, coming up in October, we have our live Money Multiplier Mastermind. It's going to be a 3-day event. I'm holding it in Nashville, Tennessee this year, and tickets are extremely limited. So when they go live, I believe it's going to be on June 1st. Go and purchase your tickets because there's very limited quantity that's out there for y'all. So I want to see you. Bring the spouses. Nashville's a freaking cool city. It's one of my favorite cities that I travel to in my van, especially because I have this specific spot that I like to go and park in right outside the Nissan Stadium. So number one, it's free parking, so I'll go boondock there for the night or two. And then it has that bridge that goes right across the river to Broadway. And so I'll go out, I'll go listen to some live music. And then when I'm done hanging out for the night, I'll just walk back over the bridge and then hop in the van and sleep for a little bit. So I love Nashville, love the live music. I love the culture out there, and everybody's just so nice out there. I didn't know this, but probably y'all do. I'm just a young girl over here. But I guess Nashville is like the bride's maid. Oh my gosh, what are they called? Bachelorette. There we go. Like the bachelorette party of the entire country. And so once somebody told me that, I started noticing, and I was like, oh my goodness, there are a lot of bachelorette parties out here because you see all the sashes on them. It says, this is the bride. This ones are all my bridesmaids. And it's really cool. So a fun little fact about Nashville. But I hope to see y'all, and I want to see you live and in person. I want to meet you. Chris Noggle will be there. My father, Brent Kessler, will be there, and a whole bunch of other folks from the team. So I'm very, very excited. With that being said, I don't think I have any other announcements. So let's get into the episode. So one question I want to address before we get into it is somebody asked me, how can all of my income really run through the policy? Because I know in Nelson Nash's book and his teachings, well, hey, don't we deposit all of our money in somebody's bank? So wouldn't it just make sense that all of your income should run through your bank rather than somebody else's bank, like the commercial banks that are out there? And the thinking and the idea behind that is absolutely true. You want your deposits to flow through your privatized banking system, i.e., the policy, rather than having it go through the commercial banks where the bankers are the ones who are making a good living off of your money. So that's all we're doing. We just want to flip the script. I'm going to make my deposits into my bank, and then now I'm going to be the one who has the freedom to earn the interest, the profits, the dividends. I can go and deploy it into other assets, buy my expenses, buy the cars, buy the vacations, send the kids to college, whatever it is. So, Hannah, how do I actually do that? Because in the policy, in the first few years, I got to capitalize my banking system. I'm not going to have dollar for dollar quite yet. So make believe if I'm profiting 100 grand a year, if I start my first policy $100,000, I'm not going to have that full $100,000 as cash value in my policy quite yet. So how does that happen? And the thinking behind it is that it's almost like stepping stones. So here's my honest feedback on this. I feel like it's almost going to be a never ending chase, okay? Because when I'm talking to new folks on the phone and you guys meet us live, or maybe you tune into my podcast show, or you follow others on the team out there on their social media accounts, you know, you guys are, I always tell you that the policy is just our glorified savings vehicle. That's all that it is. So, a good starting point when trying to implement this concept of IBC, I say, hey, take your keeping your savings monies. Let's say that you are the type of person and you are profiting 10,000 a month. All right, 10,000 is our gross income that comes in, but I got to pay the taxes, I got to pay my expenses, the grocery bill, the gasoline in the car, the health insurance, and et cetera, et cetera. So let's just say that I'm making 10,000 a year and my expenses come out to be $7,000. I just said 10,000 a year. I meant to say 10,000 a month. We're profiting 10,000 a month and our expenses monthly are 7,000. So I have this leftover 3. That leftover 3, don't just keep it down at the local bank and the bankers are the ones making the profits off of you. Start by shifting that into keeping the savings monies. That should be the dollars that start to flow through the policy. So, if now I'm making 10,000 a month and only 3,000 is going towards my policy now, I'm not to that point of income to equal premium. Yes, you're correct. Because inside of Nelson Nash's teachings in his black book, Becoming Your Own Banker, he tells us that it takes anywhere from 15 to 25 years to reach that total goal of income to equal premium. Because as time rolls on in the policy, you are going to be using the cash values to either, number one, pay off any of those bad debts that we have. So the credit cards, the car loans, the debts that are not accumulating us cash flow that's coming into the family. That's what I really want you to do with the policy first, is start to use it to pay off any of those bad debts. So then now you're starting to free up some of that monthly cash flow that's coming into the family. And we're taking back the control because we no longer have to pay the bankers back that money. So now I'm in control. I'm no longer in debt to the bank who can come and seize whatever collateral I gave them. So that would be number one. Pay off those debts so that now it starts to free up some of that monthly cash that you no longer have to send to the debt people. So now the income is rising that way, or I should even say the keeping money is rising that way, the net income. And then number two, what I want you to do is now, how do I really bridge this gap between the debt payoff to now wealth building? So, how can I go take this money that I'm saving and keeping for myself and the family, and how can I go and apply it to some cash flowing assets or investments that I like, know, and understand of where I like to go place my money just to work harder for me? Go put the little green men to work, create an army of green men that are out there working for you so that you no longer have to go out and work for it any longer. Yeah, financial freedom, but in all honesty, we're not chasing just that. We're really chasing the time freedom so we can do whatever in the hell we want to do with our hours in the day, because you can't get any more hours in the day back. You can always go out there, keep making more money. You can get more and more money and more things for yourself, but you can't get any more time back for yourself. So, when we're using the policy, go pay off the debt. That's going to produce us more keeping money in the family. And then how can I go and put this money to work to create more cash flow that's coming into me? So as time rolls on, when you're utilizing the policy, that income is going to start rising, the assets are going to start rising, that you're going to have a need to want to warehouse more and more of your monies inside of the policy. And as time goes on, that cash value becomes more and more efficient year after year. Because in the first few years, yeah, we're not going to have dollar for dollar quite yet. When you put $1 into the policy the first year, you're not going to have access to that same $1. But why are we doing this? Go back to my episode where I talk about how the policy is almost like starting a business from scratch. When we start to get into year 3, year 4, year 5, that cash on cash in that year is going to exceed our net injection that we put into it in that year. So if I put in 10 grand of premium, by that time my cash value is going to be growing by that same 10,000. But then the next year I put in 10,000, well now my cash value is growing by $11,000. And so year after year, as the policy gets more aged and seasoned and matured, that cash value is going to keep growing and growing as time goes on. And it's just because of the uninterrupted compounding that's happening inside of the policy. To include as well, it's tax-free growth to us, so the government's out of our hair. So, real life example, my mom's oldest policy, it just turned 16 years old back in February. She put $1 of premium into her policy and the cash grew by $2.47. I mean, oh my goodness, I'm not a math genius, but that's over almost 150% growth on my money just that year inside of my policy. Not to mention what mama's out there doing with her money outside of the policy, placing it to work for her. So you will see that it's going to be more and more accessible and easier to accomplish the goal of income to equal premium, because you're going to be to that point where you're pulling out more from the policy than what you even put into it. And then you're going to be having the cash flow that's coming in from your various working assets. And that's going to really build up so that you can get to the point that, hey, if I'm making $100,000 a year at my W-2 job, I'm pulling out that money from my policies and I got this money coming in from these external assets that I'm buying and these investments, and that's going to get me more than 100,000 that I'm making at my job that I have right now. So the answer here when it comes to income to equal premium, it's just time. Y'all, it's just time. And I know in today's day and age, we are impatient people. We have the drive-through mentality, the microwave mentality. But y'all, time is going to go on no matter what. So no matter if you start your policy today, sitting here in 2024, or you start it 6 years later down the road, you're going to have to still go through that capitalization period of building up that policy. So would you rather be starting it today or 6 years later down the road where you're still going to be starting at point A, right? So income to equal premium, It's going to come with time. Me, myself, I've only been doing this for 7 years. My dad's been doing it for a lot longer. He started back in 2008, and he is still chasing that income to equal premium, even after he has 28 policies and he's putting in a boatload of money inside of his policies. But it's because he's using the cash values and he's going out there, he's buying more policies, he's putting it to work in his lending deals of what he likes to do, and he just has the money in motion working, and we are still chasing that goal of income to equal premium because every single year that income keeps rising so substantially that it's just this never ending chase, which is such a good thing in my opinion. So that's the ultimate goal, though, is yes, to have income to equal premium, but don't put a dollar amount on it, right? I mean, hopefully income keeps rising, that I have to keep chasing this goal, that the income keeps rising, that my premiums have to keep increasing because the premiums are just a deposit into our banking system, right? Are we getting it a little bit now? Hopefully that helps. Okay, now that I'm off my soapbox, because this is the Hannah show, this is my soapbox time. If you guys ever talk to me one-on-one, you'll notice that sometimes I'll say that, or like on webinars or like in live events, I'll say, all right, I'm not going to get on my soapbox right now. This is why I have my podcast show where I can rant all day about it on. But now that I got that question out of the way, just wanted to give my thoughts and my feelings on it. But into the episode for right now is when and how should we pay back the policy loans, right? So when and how. Number one, my first thought really comes to, well, what are we using the money for? Okay. If I'm using my money for depreciating assets like cars, vacations, weddings, the big ticket expenses, maybe it's our tax bill, right? Whatever it is, that expense to us, that I hopefully now, since you've been following us for a little bit, is pretty straightforward. So if I go out and I purchase myself a new boat, okay? Oh, speaking of, I was down in the Bahamas this past weekend. We were staying at the Atlantis resort area in there, and they have a marina. Those boats out there are so sick. There was actually a boat, it was named Hannah, and it had and they spelled it correctly, let me say. Hannah spelled the same ways forwards and backwards. And they had it in big letters, and I took a picture of it and I sent it to the crew. And I said, all right, this is what my policies are going to buy me in the future. I mean, those boats that are out there, they're probably worth like close to $50 million. They are huge yachts. But anyway, so like let's just make believe that I want to go purchase myself a boat. And yeah, I'm not ready right now for my $50 million boat. Let's say that I want to go purchase myself a $1 million boat, okay? Still pretty expensive, but let's just call it a $1 million boat. Okay. If I'm going to use my policy to go purchase the boat, what am I going to do? I'm going to take out the cash from the policy, go down to the boat people, hand over the money, they give me the boat, and then now because I borrowed from myself in my banking system, I'm going to structure a loan repayment back to myself and treat your money just how you treat the conventional bank's money. When you borrow from the banks, you got to pay them back, and you got to pay them back with interest, and you never skip a beat in doing it. So practice those same habits with yourself and with your own banking system. So if I go down and I purchase a $1 million boat, what am I going to do now? Well, Hannah, the Bank of Hannah is going to go online, and we're going to go to the fancy website called bankrate.com, bankrate, RATE.com, and they have their loan calculators. So I'm going to plug in $1 million on the top line, which is my principal amount. And the Bank of Hannah is going to charge herself 10% interest, because this is the interest that I charge myself. You don't have to do it. You can charge yourself 5% interest, 20% interest, 1% interest. You are your own banker. This is the freedom and the control now that you have with you being your own banker. And yes, that's why you got to be disciplined with this concept, y'all. No, you can't just go out there and keep spending and think there's there's no repercussions from spending all this money that you got, right? So play honest banker, be disciplined with it. So what I do is I put that $1 million on the top line. That's the principal amount. Then on my interest amount, I do 10%. Okay. And then I want to pay this back in 5 years or 60 months. Loan calculator, calculate for me what my monthly payment has to be back to myself into my policy. And then it'll tell me. And then that's what I do. And it actually even gives you like an amortized schedule, how much you're paying towards interest each month and how much is going towards the principal. And that's pretty powerful because you can even take that to your CPA and there could be some deductions on that. I'm not a CPA or tax professional, so go talk to your professionals. But that's how I do it. I use those loan calculators, and that's how I know how much to pay myself back into the policy. If I'm doing it for like debt, right? You guys have seen our money multiplier map example, where what we do is we take the cash values out of the policy. And let's say I have these 7 or 8 debts where it's credit cards, boat loans, maybe side by sides. I got a condo that's an investment property or my mortgage, and we line it up in that format on the money multiplier map. And at that time, what we do is we just snowball the debts down. I'm going to keep making my premium deposits into my policy. I'm going to keep taking and taking the cash values from my policy. Then once one debt is paid off, now that monthly payment I was sending to the one debt, I'm now just going to add it to my next debt in line on debt number 2. And now I'm sending more to debt number 2. And then I rinse and repeat the process. Take out the cash value from my policy, apply it to debt number 2. Debt number 2 is paid off. Now the monthly payment I was sending to debt number 2, now I just add it to my debt number 3, and I'm sending debt number 3 even more monies. So we go down that line and we snowball the debts down, and see, this is where Dave Ramsey loves me here, right? Where we really snowball them all down. And then once all of the debts are completely paid off, now I'm just going to pivot that, what I was sending to the final debt people, all of that monthly money, I'm just going to change that now. And now I'm going to start paying myself back into the policy with that. So it's pretty straightforward, hopefully, in the manner that I'm explaining it here, is that when something gets paid off and you use your policy cash to go do it, don't just treat that freed up money like it's free spending fun money now. Don't take it to the casinos. Don't go down here to Bike Week in Daytona Beach, Florida, and spend it on all of the beverages and the bicycles and whatever that you like, right? So really be disciplined that once a debt is paid off, now just pivot that and start paying yourself back into the policy with that money. So that's how we're paying back the policy loans in that manner. But a lot of you tell me, Hannah, I don't have any debts. How is this concept even going to work for me if I don't have any debts for myself? Well, it's not just for debt. It's for anything and everything that you're buying and purchasing in life. You are now turning every liability into an asset, every depreciating asset into an appreciating asset, because you're funneling the money through your banking system first. You're able to earn and capitalize on that uninterrupted compounding interest. So, okay, I don't have debt. Let's say then that I have some investment deals. Okay, I'm a lender. That's what I like to do. If I have a borrower that comes to me and says, hey, I need $100,000 to go do a rehab on this property, Hannah, will you lend it to me? Sure, I'll lend it to you. I'm going to take the collateral of the first position of the property, and I'm going to charge you anywhere from 12 to 16%, just depending on how risky this deal is. So I take that money, I borrow it from the policy, I'll go give it to the borrower. Then every month when that borrower is paying me back those interest checks, I'm going to use some of that if I really need to, and I'm going to use it for some of my monthly expenses. Right now, do I? No, because I have my active income that's coming in that I don't need to dip into that investment proceeds right now. So, what I like to do is I'll take some of that money and I'll go pay back my policy loans. I'll start to build up the money that's sitting inside of my policy so that then when another borrower comes to me, Hannah, I need 50 grand. Okay, I got $50,000 sitting in my policy right now. I'll loan you $50,000. So I just keep that money in motion for me and working. So I'm creating those cash flow streams that are coming into me. So I go and pay back my policy loans when I don't have any active use for the money. No expenses that are coming up, or if I'm in a savings mode for something, saving for the next investment, saving for my tax bill that comes due annually, or maybe I want to purchase a new car or something in the future, right? So that's how I use it in the terms of my investment lifestyle. And the rule that I use for myself, if I'm not going to be using my money within about 60 days, that's when I will go and send it back to the policy as a safe place to keep it and warehouse it somewhere. So 60 days is the rule that I use for myself. My ADD is kind of going off. So let me talk about this real quick. Y'all, because it's something that the team and I have just been talking about recently. I want you guys to be aware that the insurance companies are not commercial banks. They are not doing 100 million transactions a day. So, no, when you just have like 50 bucks that you want to borrow from your policy. So, I want to take out $50 here, $100 there, $300 the next week. Y'all, you're just playing mental gymnastics with the insurance company. So, if you're going to be using that money actively within 60 days, don't send it back to the policy. Just hold it inside of your segregated checking account. And if you don't know what the segregated checking account is, go and watch my episode. It's literally titled The Segregated Checking Account and the purpose of why we use that. So I want you to be good with the policy loans that you're taking out. Be respectful of the insurance companies because we are really working hand in hand with them. We are going on this inclining trail together. They love this concept because let's be real. And this is a question I sometimes get too, but I'm just going to give you the answer, not say the question. But the insurance companies love this concept because people who truly understand the power of uninterrupted compounding, tax-free money, protecting the money, keeping the money in the family, they are not defaulting on their policies. They pay their premiums, they max out their paid up edition riders, and they are not defaulting on their policies. So, thus, the insurance companies love that because I don't know if you know this, but life insurance companies don't become profitable inside of a whole life contract until about year 7. So, they don't want that bad business on their books where people are going in, taking out policies, and then letting it lapse or they're surrendering it after year 1. They don't want that business. There's more overhead cost to what they're actually getting in that ROI of the life insurance company world. So they love this concept because folks are not defaulting on their policies and they understand it's a mutual beneficial relationship because yes, we as policy owners, we have first rights to any cash value that's inside of the policy. So the insurance company can never deny us a loan when we want to go in there and take out the money. And the insurance company, they want to give us the money because you know why? They make interest on us. Yeah, we got to pay interest on the policy loans that we take out because we are putting the policy up for collateral and we're taking a loan from the general funds of the insurance company. So they charge us interest and they love that because they make profits. So these insurance companies, they understand that when the infinite banking concept is taught in the correct manner, they love this book of business because people do not quit, they do not forfeit because they understand the importance of privatized banking. So And I get that so much, y'all. I can't tell you how many emails I get a week with people saying, "Hey, Hannah, so I heard your podcast or I learned about you from so and so. And, I got one of these policies. I got a whole life policy and it's got cash value in it, but I don't know how to use this thing. Can you help me here?" And I'm telling you, if you don't enjoy me, my vibe, or whatever, you don't even like the company name, the money multiplier, whatever stupid reason, right? Just make sure that you're working with somebody who practices what they preach and who are going to be there for the long haul and the lifetime of the policy. This is why we put so much emphasis on the implementation team and the mapping team as a resource here for y'all so that we can stay current with the banking business and what you're conducting within yourself and your life. So I don't know how I got off on that tangent. Maddie's going to be mad at me because I don't have notes today for this episode. I'm just kind of speaking from the heart today. But paying back the policy loan. So we kind of talked about using it for debts. We talked about it using it for our investments. How about like taxes? Some people ask me this because, yeah, I just had to send a hefty little check to the government for my tax bill. And I kind of shed a tear when I was doing it. So, how do I use my policy to pay my taxes? So what I did is I went online to bankrate.com and I said, okay, here's the amount that I had to send to the government. And I don't have to charge myself interest if I don't want. I do personally because the more interest I charge to myself, it's just going to be more money back inside of my pockets that I can go and deploy into these different investments that I like. But I don't have to. Let's say I don't even pay myself this interest for right now. And here, I'm going to grab my cell phone here and let's just do like easy, simple math. Because if, let's say that I owed the government, and I'm using hypothetical numbers, let's say I paid the government $30,000 this year for my taxes. So I paid them $30,000. And what I'm going to do now is I'm going to save up. I'm going to save up inside of my policy, prepping for my next year's tax bill. So if I take that 30,000 divided by 12, all right, that means 2,500 bucks. So what I'm going to do is I'm going to pay back $2,500 over the course of this year so that I'm prepping and I'm saving back up for next year's tax bill. So that's what I do. And it's hopefully it's coming across as that stupid simple because I'm telling y'all this concept is that stupid simple. Now, what about for my folks of, hey, well, what happens if I got extra money? Okay, well, I'm paying myself back. I just paid the government. I'm paying myself back the 2,500 bucks. But Hannah, get this. I also have an investment that's coming back to me. What should I do with this lump sum of money that's coming back in? And I touch on this quite frequently. What I want y'all to do is sometimes y'all will come to me and say, hey, I think I'm ready for another policy. And that's when we kind of assess the cash flow. But let's say you're not ready for more premium commitment right now. What you can do is you can go inside of your policy and let's say you're doing monthly or quarterly premiums right now. My first advice to you would be, well, let's pay up the policy premium for the year. Change that policy to an annual premium. Just pay it up for the entire year. Let's say we did that, we got more money left over. Well, hey, let's put some extra paid up edition premium into our already existing policy. That's going to keep compounding the cash value in the policy, make it mature even quicker. And then if we've completely paid our annual premium, we've maxed out our paid up edition riders, then we got more money that's still left over. That's when I would say that you're ready for policy number 2 and you're ready to start pushing more and more of that cash flow through the policy. But maybe that's not you. Maybe you're saying, but Hannah, no, I'm ready. I want to start more policy premium right now. I got a lot of extra cash flow that's coming in. I know we spoke on the initial forefront and I was only keeping about $3,000 a month of my income, but I'm now keeping $5,000 a month. Well, it seems like you're ready for another policy policy, a 2,000 a month policy. So now you have a total of 5,000 monthly cash flow that's going towards policy premiums. So hey, let's maybe start policy number 2. Don't max out number 1 quite yet. You can start policy number 2, and then you could do a dump in into policy number 2. And that's how you can get some of the windfall money funneled through the policies. So, y'all, there's so many different ways and strategies that you could do with this stuff that I mean, call me, call the team, just strategize and talk through it with somebody. Because I'm telling you, what's really, really funny when I'm on the phone with y'all is that we'll be chatting and you guys will answer your own damn question. I'm just here apparently for moral support to bounce ideas off of, which I love. But you guys have that answer inside of you and you know what you should be doing. So we're here. If you want a second opinion and you just want to bounce some ideas off of us, I'm always here to have those conversations with y'all. But it makes me giggle a little bit because, and I'll call y'all out on it. I said, do I even need to be here? You just answered all of your own questions. So when and how do we pay back the policy loans? Be disciplined, follow your strategy, and you should walk into it with a strategy. Don't just be flying through like a black box. I want you to have a definite strategy of what you should be doing with the policy before you even go in there and take out the policy loan money. Really analyze, okay, after I go and give this money to my borrower or maybe an investment of some kind, what am I going to do with those returns that I get back to me each and every month? So, you guys are smart individuals. I'm so happy that you're here. And hopefully, there was some value and some nuggets that you picked up on this episode. I don't think I have any more thoughts as of now. If you have questions, I will here in the near future do another episode on the questions that I get left in the comments here on YouTube. But I think as of right now, that's all my thoughts I want to give. Because I'm looking at the time clock right now. I got some scheduled meetings coming up here in about 10 minutes. And then also, I'm going to go get a haircut today. So I'm excited about that. Miss my Lisa girl. It's been a while. Ever since she's seen me last, I've been to New Zealand, Hawaii, the Bahamas, Texas. I've just been freaking everywhere. And it's like, my dead ends. We need some chopping going on here. So, with that being said, I appreciate y'all for tuning in. Catch me next week. I'll come back with another live episode, and I hope to see you at the Money Multiplier Mastermind. It's going to be so fun, so cool. I got a lot of great presenters and speakers that are going to come out for it, even some home office officials. So you'll be able to meet those people of where your policy is held. Just great people. Because, at the end of the day, this is a relationships business. Yeah, I'm a money mentor. I'm in the financial world, and I love just telling y'all what I do in my life and how I'm utilizing my policies and my banking system. But you meet some really cool individuals along the way that maybe at first it starts off as like just a working relationship, but it really blossoms into a friendship and almost like they're your family at some point. So, again, I'm feeling grateful as always, alive to see another day, and I'm always here to help y'all. So send me an email, podcast@themoneymultiplier.com. If you're watching on YouTube, you can scan my QR code right here. Let's get it in focus. There we go. Scan that QR code. It'll take you right to our presentation if you haven't seen that yet, which really labels out the foundation of how are we practicing this concept? Why do we want to do it? How are we doing it? And this is your check-in reminder because we're here now in quarter 2. Have you reread Nelson Nash's book, Becoming Your Own Banker? Reread that book at least one time a year. Listen to the audio. And you can also send me an email. I'll send you a copy of our ebook, Mapping Out the Millionaire Mystery, a book that my dad, Chris Noggle is not my father. Brent Kessler is my father. That my dad, Brent, and Chris wrote together. I'll send you a copy of that ebook. If you want a hard copy of it too, send me an email with your address and we'll mail one out to you as well. Now, before I log off here, I do want to talk about how we pay back the policy loans. It's very easy, okay? How money flows in and out of the policy is through an ACH or like a direct deposit. So, whenever you want to request your policy cash value, you'll have your own login portal directly to the insurance company's website. Log in there, request a loan. You'll see it get deposited within 30 days. Yes, it happens faster than 30 days, but I just like to tell you within 30 days because I like to underpromise and overdeliver. So, how it happens is that money will go into the policy ACH. You can request a loan, it'll come out of the policy ACH. And then anytime you want to pay back the policy loans, you'll have your own login portal, pay back the loans online that way. Or some companies will even allow you just to call them up over the phone, give them your account and routing information, and they'll even pay back the policy loans that way. You can even pay your premiums over the phone at some companies too. So, very simple. That's how money flows in and out of the policy, and that's the how we pay back the policy loans. Thank you for tuning in, and until next time, I'll see y'all later. Bye, everybody.